If you are casually considering investing in real estate, it's hard for me to recommend that because you're going to be at a disadvantage to people who are doing it professionally. So I personally choose not to make casual investments of that size and scale where I have no real time to dedicate toward them. I've been a financial advisor all my adult life, the first and only job I've ever had. I appear on CNBC's Halftime Report and Closing Bell each week, and I run an investment advisory firm in Manhattan with 33 employees and about 1,200 households that we're responsible to. Look, I think real estate is one of the primary ways in which Americans have built up wealth. It's a phenomenal investment, but you should not look at your home, your primary residence, as an investment. It's really a form of consumption. You own the home as opposed to paying rent for a home that you don't own, but you have to live somewhere. So I think when you look at the inflation-adjusted history of the United States, we're like housing, you're really talking about like 1% a year in return. So it's not a great investment. Now, you'll find people that happen to have bought a house on waterfront property in the 1970s, and that is, of course, appreciated far faster than the average house all over the country. So they will look at their own personal experience or the personal experience of their father or grandfather, and they will say, real estate's the best investment ever. So I think a lot of opinions about whether or not to invest in real estate come from anecdotes and not data. When you look at the data, not only is the average annual growth of the price of a home nothing to write home about, especially compared to the stock market, it's got all these other costs involved. Taxes that you pay, maintenance that you're forced to do, renovations that you'll do over time. And most people, when they quote how much money they made on their house, they'll forget about all that stuff. And they'll say, we bought the house for $50,000, sold it for $250,000. It's the best investment ever. And then you almost feel bad. You don't want to go back in time with them and point out all the other stuff they're not accounting for, and then adjust that for inflation, and then average that out over decades. And then they say, maybe it wasn't so great, but you don't want to do that. I don't personally invest in real estate outside of REITs that are publicly traded in the market. Anyone can buy a REIT. They trade on the market like common stock. REITs are real estate investment trusts. So similar to publicly traded corporations, one of the major differences is they don't retain earnings. They have to pay out almost all of the profits that they make, and that payout is called a distribution. It looks just like a stock dividend. It's paid out on a quarterly or a semi-annual basis, and that's one of the primary features that people buying REITs are looking for, that current income, usually rents being passed through, but there are many types of REITs that are not just real estate that you can live or work in. There are hospital REITs, there are cloud computing REITs where it's basically a server farm paying out income. There are cellular phone towers that are being paid rent by the mobile phone carriers. So people use REITs to supplement their current income. They're a little bit of a cross between a bond in terms of the income, but they have equity-like volatility.
Invest in you. Ready, set, grow. CNBC and Acorns.